Good evening, and in this video what I want to talk about is what happened on the Swiss franc currency last Thursday in fact. And the dust has settled a bit now, so we've seen what the market's done afterwards, but I want to talk to you primarily in this video about risk and how managing your risk, that despite a freak occurrence like we saw, if you were in that trade, you still should have been able to walk away relatively unscathed. And the reason I also want to talk about this is this affected me personally, because I was actually long Swissy at the time. So I was long a US dollar against the Swiss franc. So what happened? Well, essentially last Thursday, not the European Central Bank, the Swiss Central Bank decided to unpeg their currency. It had been pegged against the euro for a while, and it decided to unpeg it, and it was a shock to the market because no one was expecting it to actually happen. So as a result, there was a big sell-off, and you can see that on the screen there. So the market fell very, very quickly. So why would that affect you? Why would that be an issue? Well, if you were trading a pair that was associated to the Swiss franc, so something like the euro against the Swiss franc, or the New Zealand dollar, or the pound against the Swiss franc, or as you can see here, the US dollar against the Swiss franc, what that would mean is that because that move was very severe, now you can see there that candle moves down it moves a huge distance. It actually was nearly 2,800 points. Some say one of the biggest moves, or in fact the biggest move in any currency pair that we've actually ever seen. So it was a real shock to the market. There was a big sell-off. It's a little bit like a dam, and you've got a dam there, and in that dam you've got a small amount of water being let out of the dam just to relieve the pressure, just a small amount of water constantly being let out with all the water sat behind, and then suddenly bang, the dam bursts and all the water just comes flooding through. So as a result, specific levels where you had trades, you may have got what's called slippage, which is where your trade, or the exit of your trade, is at a different price to where your stop was. And this is exactly what happened to me, and it also happened to a couple of our members as well. But I've also heard some horror stories about people having their accounts wiped out, and the purpose of me telling you that and telling you a bit more detail as we go through is not so you become fearful, but so you understand how important it is to manage your risk throughout this whole process. Okay, so if you look at the chart that's in front of you, I've got a 4-hourly chart of the US dollar against the Swiss franc, and it's a little tricky to see because the chart has changed in terms of shape. It doesn't look much, but I got triggered in just there. So what you can see is I got triggered in just there, and I was actually long with my stop at the blue line that you can see just below it. So I was looking for a move up just to around this level here, and what you can see is we went sideways a bit, and then suddenly bang, we had the move down. Now this was a swing trade, so essentially I knew the news announcement was coming about Swiss interest rates, but I didn't know that this was happening. Like many other traders, there may have been a few people in the know, but I certainly wasn't one of them. And as a result of that, what we saw is this move. Now what happened is I was looking at the trade, and I went straight away. We were in the trading room, and one of the guys in the trading room, actually Patricia, one of the girls in the trading room, she called it and she said Swiss franc is tanking. So I immediately went to my broker, and I saw that I would have already been stopped out. So I looked at the position and went yep, and I confirmed that with my broker that I had my sell stop order taken out at this level here. And to be honest, at the time I thought, well, I'm pretty lucky to have actually been able to get out of the trade, considering how quickly it moved. I mean, it moved very, very quickly. Price was gapping, whereby orders couldn't get filled, so the price had to gap. You can't see it on the hourly chart, but price moved very, very quickly. And then what happened is, at the end of the day, I noticed, well, the next day, once the account had been cleared off, is that I noticed that this trade had been refunded. And what happened was, I had actually had a trade take me out, and the same trade had actually taken me out here because the broker was saying this was the best price that they could get on that day. And in fact, the computer had got me out at this price, but they weren't able to fill it until this point here. Now, for sake of argument, that was approximately a further 4% more, which meant I lost, I think it was just over 5% on the trade. Now, for me, that's quite a bit, and for a lot of traders, in one trade to get hit 5% is quite a lot. But what's frightening is, I know from the stories that I've heard, is a lot of people had 5-10% at risk on similar trades. Not our members, but other people that you hear through the trading grapevine, and people talking to other traders and everything, and stories coming back, where as a result of that, people had lost up to a quarter of their account. I'm going to explain something in a second. It's vitally important you understand it. So the long and short of it is I lost 5% on that trade because I was slipped from where my stop was to the best price my broker could get. Now, as a result of that, a lot of people were left exposed. Now, imagine it from this perspective. So there's me with a 1% risk, and I was slipped 5%, so I have a loss of just over 5%. Now, if you'd risked 2% in the same scenario, obviously you would have had a 10% hit given the same scenario there. But what if you'd risked 5%? Then the same hit could have been anywhere up to 25%. But here's the kicker. What if you'd risked, say, let's say 5%, but your broker had not got you a 5% slip like I got, and based on my overall move, but actually you got a 20% slip. In that scenario, that 20% slip would have only cost me 20%, but has cost this person their entire account. And I have heard of stories of this happening to people. So primarily what I'm saying is the most important thing to factor in here is, number one, is make sure that you always manage your risk regardless, because you never know what might happen. Now, this is the first time such a move has happened to me. There was the big move back in on the Dow a few years ago when we had a big move down, a big move up, and people got caught on that as well. So what I'm saying is, don't be fearful. Don't suddenly clamp up. Don't suddenly not trade. Don't suddenly think I must use guaranteed stops. Just manage your risk correctly. Make sure you're only risking 1, possibly 2% on your trade, and have a plan to make sure that you stick to that, and make sure psychologically you don't get caught up, because you could have been on the other side and it could have been the greed element that was impacting you. And essentially what that could mean is you could be sitting there with a bigger profit than normal, and you're starting to get a little bit excited. You might have wanted to get back in the market. When you get extreme events, the most important thing to do is walk away. I was discussing this with the guys in the trading room, and also the other trainers that I work with, Ian and James and Sally as well. And what we said is, make sure that you step away in scenarios like this. So when you get an extreme event, if it hits you and it's hurt you or you've benefited, is step away. So manage your risk. Stick to 1 to 2%. Yes, it means your account will grow at a slower rate, but it will grow at a safe rate. Number one rule is always protect your capital, and that's the simplest and easiest way to do it. I remember hearing, it was about 4 years ago, the trouble with risk management is too many people complicate it, when in fact risk management is very simple, but what you've got to do is you've got to stick to it. So if you do get the currents like this, you're still okay, and you can come back from it. So stay trading safe, guys. I'm going to come back to you with part 2 very shortly of what's happening with the Dow, but I thought this was important just to get this message across, because this is something that we don't often see. So I hope you enjoyed the video. Don't forget to subscribe, click on the link, and I look forward to seeing you very soon.